Welcome to the Mortgage Update with Dan Frio. For over 10 years, Dan has been helping AM 1160 listeners. With so many companies to choose from and hundreds of loan options, the mortgage process can be confusing and costly. Be sure to listen each day for Dan and learn the difference between FHA, VA, and conventional loans. You'll also learn how to negotiate lower interest rates and fees, as well as steps to buying your first home and whether refinancing makes sense. Stay tuned to find out why Chicago's top realtors are choosing Dan Frio.
Welcome to the Mortgage Update with Dan Frio, and I, of course, am Dan Frio. Got a special guest here with me today, John Maxim from Illinois Housing Development Authority, also known as Ihda. So I only thought that Ihda had one, maybe two different options to choose from. As I'm finding out more and more and more, there's, I know, 4, if not more. So if you can kind of lay out all the options people have and what, why somebody would go with option A versus option B and so forth.
We develop programs to help different types of scenarios.
Okay.
With the access programs, the 3 programs I'm talking about, it's first-time or non-first-time home buyers. Meaning, if you own a house now, you can buy a new one and retain the current one. Of course, lending rules, FHA, you can't have 2 FHA loans, but right. You know those. Yeah. You'll discuss them with that. These 3 programs are available in any county in Illinois. And these 3 programs, the First Home Illinois, because the source of funding does not allow for new construction, but the access programs do. So say you're buying a new construction house, the final loan, you can use our assistance for a new construction house.
Sweet.
So the first option we have, it's called the Forgivable Program. It gives the borrower 4% of the purchase price with a max of $6,000. And what that means, if they're buying a $100,000 house, they would receive $4,000 in assistance. They're buying a $150,000 house or above, they would receive $6,000 in assistance. The way that works, it's forgiven over 10 years. Okay? They have a second mortgage for, we'll use the $6,000 if they're buying a $150,000 house or above. They have a $6,000 second mortgage. Mm-hmm. Every single month, they're making a payment on their main mortgage, $50 would be forgiven. So if they stay in that house for 10 years, do not sell or refinance, that $6,000 is forgiven.
Okay.
If they do sell or refinance before that 10-year period, they will pay back that prorated portion which isn't forgiven. So to make numbers simple, say they stay there 5 years on the dot from that first payment, they pay back $3,000.
Gotcha.
That's the Forgivable Program. The Deferred Program, I like to think of it as a deferred loan. Okay. We're going to give them 5% of the purchase price up to $7,500. So using that $100,000 example, $100,000 purchase price example, they will receive $5,000 assistance. If they're purchasing $150,000 or above, we're going to give them $7,500. Okay. This is a deferred loan. When I give trainings, I like to give an example. This is like borrowing money from a rich uncle or an aunt or a family member. All right. There's no interest. None is forgiven. But when you sell or refinance or keep that mortgage, your first mortgage for 30 years, you will pay it back. So it's interest-free money. It just sits there. Think of it as a silent second. Yeah. So when you go to sell or refinance, you will have to pay it back.
Gotcha.
But it allows you to get in the house. All right? And then that's the Ihda Access Deferred. The third option we have is Ihda Access Repayable. And what that is, it gives you 10% of the purchase price up to $10,000. So if you're buying $100,000 or below, you take 10% of the purchase price. $100,000 or above, you would receive $10,000. That $10,000, it is repayable. Okay. You will pay it back over a 10-year period at 0% interest. And if you get the full $10,000 on a purchase price, $100,000 or dollars above, you're going to pay it back at $83.33 per month. So if you went out to a borrower, Dan, and says, I can give you $10,000, 0% interest. Would you use it to buy a house for $83 a month?
You betcha.
Absolutely. I mean, that's where our programs, come into play. With this program, if they're buying a low purchase price, maybe they have a little bit of money saved up. Yeah. Maybe this $10,000 puts them down to 20% down on a conventional loan and they avoid MI. So there's all kinds of situations.
I see what you're saying, yeah.
All 3 can come into play.
Got it. Okay, so I'm going to be devil's advocate, kind of, sort of. If I'm looking at these, okay, I can get the repayable one at 0% interest, which is awesome for 10 years, but I need to make an $83 payment. Or I can get the one that's 0% interest, but I pay back. I no payments, but I pay it back eventually when I sell my house. Or I can get free money. And this is in my head, so just bear with me on this one. Why do a lot of people not choose, or maybe they do, the forgivable one? It's basically free money that's just, you don't pay it back ever, unless you sell the house prior to 10 years.
A couple reasons might be why. You might be planning to stay there a couple years.
Okay.
So not that much is forgiven. And then another important factor that comes into play is the amount of assistance, how much you need to get in the house.
Okay.
So say, like I said, you're buying a $100,000 house. Let's just use that scenario. On the forgivable, you get $4,000. On the repayable, you get $10,000. That $10,000 when you're purchasing can make a difference. So
huge difference.
It just depends.
To pay the juice of $83 a month, not bad.
Yes,
Got
exactly.
it. Okay.
And that's 0% interest. So you can't really find that anywhere to buy a house anyway. So.
Got it. So I was going to ask you some questions about like veterans and other things like that. But you can do a VA loan, basically, and get in that case, you could probably go with the forgivable at 4%, because even with a VA loan, you have, and most people don't understand this, it's 100% financing. However, you still have closing costs, and those closing costs are probably going to be about $5,000, between the lender fees, the title fees, and everything else. So could you use the forgivable on a VA loan and get these, let's say it's a $150,000 loan, get the $6,000 to pay basically your closing costs?
Yes, you can do that.
Okay.
You can also use it. There's a VA funding fee. You're the lender.
Right, yeah.
But you can use it towards that instead of just financing it in the loan and everything. So yes, you could.
Gotcha. Okay. What other programs does Ihda offer other than, and there might be and there might not be, but we went over 4 phenomenal programs. But what else does Ihda do?
All right. Not to bore you, but we have an Refi program. This is for underwater borrowers. It's not a main program it's used, but I'll go through it real quick. So just so you know about it, Dan, for customers, or you can help somebody. The Refi program, it still has the restrictions of our income limits. They're around 100,000 depending on county. Still need a 640 credit score. You need to credit qualify for refi, okay? It's for borrowers that are underwater on their mortgage. Underwater meaning, I'll give you a scenario. Say they owe $125,000. The order of appraisal comes in at $100,000. There's not many solutions right now. What the lenders that offer this, what they will do, they will give them a new loan based on that $100,000, anywhere between 90 and 97 LTV. So I'm going to use 95% LTV. LTV is based off the appraised value, but they're going to give them $95,000 loan.
Okay.
They owe $125,000. What Ihda is going to do is we're going to give them that $30,000 plus money towards closing cost.
Okay.
So let's use $5,000 like you used in another example. We're going to give them $35,000. You're going to give them the new loan. We're going to give them $35,000. That money's forgiven in 3 years. So if they stay in the house 3 years, they're going to have a mortgage for $95,000 at current interest rates. We're going to give them $35,000 forgiven in 3 years. So it's for people that have paid their mortgage on time and they're underwater.
Wow. Phenomenal program. So I want to thank John for coming in today. Thank you so much. It was an eye-opener for me, and I've heard all about Ihda for years and years and years, but as an independent broker, I wasn't able to offer it. Now I'm happy that we at Parkside Lending are that we can offer this program to everybody out there in Illinois. So what we want to try to do is get the 1 out of 6 or 1 out of 10 people that's buying their first home and get them more familiarized with this program. I'm going to throw 10 questions at you. They're what I would consider the most frequently asked questions in regards to a down payment assistance program. So you ready?
I'm ready.
Don't strike out.
All right.
You're the household expert.
We haven't even gone over these, so
Gotcha.
I'm ready.
So yeah, we're just flying on this one. So the first thing is, and there's no specific order, but the number 10 is basically kind of, I think, one of the biggest questions there is. But the first one is, what is the minimum credit score needed to qualify for the Ihda program, or the minimum of any of the programs?
It'd be a 640.
640. Okay. So just if you're out there and you have 3 credit scores, there's TransUnion, Equifax, and Experian. If you don't have your credit score, don't know it, let me know. But most people do know it. So a 640 credit score is the minimum credit score allowed to get you into this program. Now, the next question I'm going to have, and you'll know what I'm talking about, but I'll explain it here in a second. What is the maximum debt ratio, or we call it in the business debt to income ratio, to qualify? Here, let me explain what your debt ratio is for those that don't know. But it's pretty simple. Debt to income ratio is your debts, so everything on your credit report, plus your proposed mortgage, that's your debt, divided by your income, so debt to income. So if you have $10 in debt and you make $20, you're at a 50% debt ratio. Hope you get it from there. So what's the debt ratio qualifications for the Ihda programs?
At 45%. That's 45%.
Okay.
Yep.
Did it used to be 43 or no?
I've been there 6 years. It's always been 45.
Okay.
It might have been before
For some reason, I thought it was 43, but that 45 is awesome. And that's where a lot of conventional financing puts you. So that's a good trigger. So a 640 debt ratio. And if you need help calculating this, guys, if you have a 640 credit score, you're interested in doing this, just call me. I'll walk you through it. Okay, the next one. And a lot of people had problems, 10 years ago, when I always say the world ended. A lot of people went through foreclosures and short sales.
That's a great question.
How long do you have to be out of a foreclosure or short sale to qualify?
I could sort of put that question back on you. How long do they have to be out to qualify for FHA loan?
Got it. Okay, so basically you go off of the guidelines that we're qualifying you for.
Yes, that's correct.
So if it's a shorter time, we're going to look at going with an FHA program. If it's a longer time, we're going to look at going with a conventional program. So, okay, that answers that question. This might be the same answer to this one. How long do you have to be out of a bankruptcy to qualify for the Ihda programs?
That would be the same answer. Whatever agency.
Okay.
Yeah,
so it goes off of the FHA and the conventional guidelines. Right. And you can check out my other podcasts, YouTube channels, and other radio shows. I basically break down how long you have to be out of foreclosure, how long you have to be out of bankruptcy to qualify for different programs.